I'm John Katz. I'm a London-based investment strategist and researcher, and I'm co-author of the Goldwatcher. I'm neither a gold bull, a gold bear, and certainly not a gold bug. And I don't even claim to be a great expert in gold. My co-author, Frank Holmes, is one of the world's most authoritative voices on gold. And we agree that gold is not an investment you should think of to get rich quick. And the watchword with gold is moderation. This is because gold is a sterile asset. It pays no dividends, it yields no interest, and it costs money to keep. That leaves us with a valuation circle to square. Where do we begin? I find a useful starting point is to see gold as a two-sided coin. One side of the coin for gold is a commodity used mainly in the manufacture of jewelry, and the other side of the coin for gold as money or a quasi-currency. Let's start with the side for gold as a commodity. That's nice and straightforward. All the information is available in the public domain, supply, demand, production, etc. But it's a very different story when you come to gold as money, or gold as an investment, or gold as a commodity. And this is because gold used to be at the center of the world monetary system, but the dollar usurped the position of gold over the 20th century, and the dollar is now at the center of the world monetary position. So to take a view on prospects for the gold price, which is what we're all interested in doing, we have to understand the dollar, we have to understand the factors that affect the dollar and how that can affect gold and our investments generally. Until the outbreak of the First World War in 1914, you have probably had a few gold coins in your pocket, along with other sort of coins that weren't of any great value in terms of the metal in them, and banknotes. And under the gold standard, you could take those coins and the banknotes to any bank anywhere in the world, and they would give you the same amount of gold as they would in the country where you originally got them. The gold standard was suspended by the parties fighting the war at the outbreak of the war, and they did that for a very good reason. They wanted to be free to print as much money as necessary to finance the war. At the end of the war, for many reasons, the gold standard never came back with the same cohesion as it did before the war. And in fact, the world monetary system ended in a horrendous mess, not all that dissimilar to conditions we're experiencing now. It ended with the Second World War. And at the end of the Second World War, there was the famous Bretton Woods Conference, when a new architecture was worked out for the world monetary system. And in that arrangement, America was the absolute victor of the war, the richest country on the earth, and the dollar was crowned as the global currency. But the link to gold was kept. Gold was the standard measure of value. Everything changed in 1971 when American President Richard Nixon, burdened by Vietnam War debts and other economic problems, severed the link between gold and the dollar and severed all links between gold and the international monetary system. And effectively what happened is the world got pitched onto uncharted financial waters. There were some difficult years that followed, very turbulent years, reflected in changes in the gold price. The gold price had been set by President Franklin Roosevelt at $35 an ounce in 1934, when he devalued the dollar from $20.67 per ounce to gold. That price remained until 1971. By 1981, the gold price had increased to over $850. But over the next decades, the world economic situation settled down again. And by the end of the 20th century, the dollar was back in its perch and gold was below $300. Then everything changed again at the beginning of the 21st century, particularly after the 9/11 terrorist attacks in the United States, followed by the wars in Afghanistan and Iraq, followed by the housing bubble and bust, and the subsequent problems with defective securities being sold all over the world, and the situation we're facing now. We now have a new president coming into office in the United States, President Barack Obama, and he has already announced his policy will be great fiscal stimulus and deficits that could run to $1 trillion a year for the next few years. What does this all mean to us? If we look back on history, whenever financial matters have been left to run without constraint, the value of paper money has been eroded. And alas, the value of paper money is that it generally loses more and more value until eventually it's valueless. Could that happen again? Well, it may not, but it could. And in view of that, investors have to think of spreading their risks across a portfolio of assets, some of which will protect them from the fallout of the worst outcomes in a global financial upset. Gold comes into that equation because it is a financial asset with a different risk-reward relationship to other financial assets. Other financial assets can go down in value at the same time as gold goes up. Should you at this stage consider protecting yourself against the risks in the financial system? The answer to that question has to be not only should you, you must. Is gold the right investment for you? That's a question that I wouldn't dream of trying to answer in a short interview like this. But in the Goldwatcher, I do explain when owning gold makes sense and when it doesn't, and when gold prices make sense and when they don't. And in the book, you will find that you gain an understanding of the situations where owning an asset like gold can help protect you against bad outcomes. Of course, a book is always written a long time before people read it. And in the Goldwatcher, we have the advantage of having a blog, www.thegoldwatcher.com. And on that blog, the discussion on the various issues that are affecting us now, including the talks of a new Bretton Woods arrangement, and the outcomes of these talks and factors that can affect the value of our assets and gold, are all followed up.